we continuously get this question if the US economy is in a bubble or not, right? Or if it is worth investing in the US economy right now at this point in time. So a few things, I think bear thesis you've already heard a lot, so we'll not go a lot into the details. But yes, Trump is unpredictable. He does things randomly. So he's put tariffs randomly on countries. He has had a regime change in Venezuela. So all these things are negative. Absolutely, they are negative for the economy. But to what extent? It may be negative to a certain extent, but that doesn't change the bull thesis if it's not going to impact the markets much. So I think what happened in Venezuela is a blip. There's nothing to worry about that over there. Some things keep on happening. These are big economies. You are talking about the world stage, and they don't impact the markets as much because those economies like Venezuela, they are not a major GDP contributor. They are not a major revenue contributor. And they are not a major oil supplier either, as we saw from the first slide. They do have reserves, which means it's in the ground. But in the ground and bringing it outside, making it usable, you have to go through drilling, you need refineries. It's a long process. It's going to take a lot of time. So those are smaller issues which generally for investors, it takes them off the main important parts of the investment thesis. And that is just noise. What we want to say is that don't worry about them. That is just pure noise. On the bull thesis, why we feel this is a good time to invest in the US is we'll discuss through a few points over here. As Sunil earlier in the session, he mentioned that we are in a monetary stimulus environment right now, where the Federal Reserve, US Federal Reserve, is cutting interest rates. Historically, there has never been a single instance. You see all the green bars over there. Those are the instances where US Federal Reserve cut interest rates and the US was in a non-recessionary phase. US is not in a recession. US GDP growth last year and next year is expected to be 1.9%. So when the Fed cuts interest rate in a non-recessionary era, the next 12-month returns for the stock markets have always been positive. There is not a single instance, if you go all the way back to 1974, where the Fed started cutting interest rates and the 12-month forward returns were negative. So that gives us a lot of confidence that the chances of a negative returns when the Fed is cutting interest rates are pretty low. So we should not be worried about that. So that's the central bank part. The other important part is the fiscal stimulus, the One Big Beautiful Act, OBBA, that we discussed in the earlier slides. So One Big Beautiful Act does give a tax cuts to individuals, but it also gives massive tax cuts to the corporates. So you will see that a company like Google generally generates about $75 billion of cash annually. From the first year of the tax cuts from OBBA, which now will come into play in the first quarter, second quarter, third quarter of 2026, is they'll generate an additional $25 to $30 billion of additional cash flows. So 1/3 of Google's last year's cash flow, they are just going to get from the tax cut. And so that's a huge boost to corporate margins, to corporate earnings, and corporate spend, because when Google gets an additional $25 billion, they'll definitely spend it on AI infrastructure, they'll spend it on chips, they'll spend it on R&D, lots of other, and similarly, every other company will do that. It's not only Google, the tax cut is applicable to the entire US corporate sector, and so everybody is going to benefit of that. So two factors so far we discussed. One is the central bank is cutting interest rates, which is very bullish for the stock market. Second is the government is cutting taxes, which is also bullish for the markets. And then again, we just go to the general market valuation. It is maybe 10-15% above the historical 5 and 10-year averages that you see in the chart over here on the left-hand side. So if you are 10-15% above historical valuations, and when you have such massive tailwinds, which is bullish for the stock market, one should not be worried about valuations for now. So from a valuation perspective, we are quite okay for the entire S&P 500. moving on to some comparisons. This is one slide which is very important because I think people miss the part that if you are worried about smaller things like Venezuela, you will miss these returns by not investing in these markets, right? So we did a comparison about with Nifty, which is the blue line that you see over there, and versus the S&P 500, which is the orange line that you see over there. So the returns over there you will see are more than double. If you take a last 15-year history, we are not talking about 1 to 5 year. The returns for the S&P 500 have been more than double of the Nifty. So what are some of the reasons for that? Because we certainly know that US GDP growth historically and also in the future is generally in the 2 to 3% range, versus India grows at the 5 to 6% range. So why is it that the US stock markets keeps outperforming the Indian stock markets, and not over 1 to 5 year period, even over a 15-year period? And you can go back further, you will still see the outperformance. The point being here is there is massive outperformance. So what is the reason? One big reason is that US companies have global revenues. Only on the right-hand side chart, you will see only 52.2% of US S&P 500 index revenues come from the US. So roughly half comes from the US, and about half of their revenues comes from outside of the US, which means they generate revenues when China grows, when Africa grows, when India grows. All of these regions, they have sales in. We use global products. We use Microsoft, we use Google, we use Apple, right? We use NVIDIA chips, we use Intel chips. All of these companies, they grow from growth outside of the US also. And that is why they are not just dependent only on US growth for their earnings growth. Consequently, the earnings of US companies grow much faster than the US GDP growth, historically also and in the future also. And that is the reason we believe that the US stock markets outperforms other indices as well as the Indian stock market, even though the US economy has a lower GDP growth. Secondly, corporate governance, management, and capital allocation are top-notch. We have never seen such phenomenal corporate governance, neat and clean management teams, as well as capital allocation anywhere around the world. These are some of the best teams that are working for you. So totally from that perspective, non-corrupt, very motivated with the right incentives. You have perfect combination of a good ecosystem, global growth, global sales, and management that is aligned with minority shareholders, that provides the perfect nurturing ground for companies to provide extraordinary returns from the stock price perspective. So I think that's another reason why we do feel that these companies and these stocks outperform their global or other non-US peers. The last but not the least, and this is the most important part for you to understand in this entire presentation. If there is one thing that you want to understand in this entire presentation, is this idea that US companies grow without capex, and that brings phenomenal earnings to these companies. So let me give you an example. Since we are all based out of India, let's take an Indian example, right? Say a company like Maruti, if they want to double their revenues, they have to double their production. To double their production, if they have one factory that is building cars, they have to build another factory to build double number of cars. Consequently, they have to invest. If the first factory cost them $1 billion, the next factory that they're going to build is probably going to cost them more than $1 billion. Let's assume it costs the same. So if you have $1 billion invested in a factory, which you are running for the last 10 years or 20 years, now you have to build another factory, which requires capex. For this, you have to either go to the banks and borrow and then pay them interest, or you have to deduct it from your cash flows, which means that cash flow that was supposed to go back to the shareholders is now put in the ground for building a new factory. And this is the problem with all emerging market economies, where these are cash guzzlers. You will never hear about an emerging market company giving money back to the shareholders in terms of either large dividends or share buybacks. None of that happens. They are constant seekers of capital. They come for a secondary issuance, they come up with lots of IPOs. They always want more and more capital. It is because of this feature of emerging markets where you need massive amounts of capex to be done for any growth. Versus now, contrast that with companies in the IP space whose earnings and growth comes from their intellectual property, not from building another plant. Easy example, which everybody understands, Google. When Google introduces their services into a new country, like say India, or in a new geography, or a new service altogether, now they do not have to double their plant and machinery. Basically, they don't have to, if they have one plant, they don't need to build another plant. And so any revenue they generate from that can directly go as either dividends or it can go back to shareholders in the term of stock buybacks. And that's what these companies do. Most of these companies have 50, 70, $80 billion stock buyback programs every year, which means they're returning shareholder to the capital, as opposed to companies in emerging markets. They're always sucking capital from the shareholders and asking for more and more capital. And so because of that, they don't have to borrow from the banks. Most of these companies, they don't have any debt on their balance sheet. So they can easily return that capital to the stock shareholders, minority shareholders. And that's why the stock consequently performs much better than the GDP growth that you see in the US stock market. So if we find such companies at a reasonable valuation, that is the best way to invest. You rarely find such opportunities in the world where you get good management teams, a good ecosystem, everybody's incentives are aligned, and the returns from those investments are phenomenal because they are all IP related investments. This is some of the best and very fertile grounds for finding good return stocks. And that's why we strongly believe that these companies will continue to generate the returns that you see in this slide over here that they have generated over the last 15 years also. And so I think we are not too worried about anything else. Overall, it's a good time to invest. You have good companies, good returns, and so one should invest. So once you have agreed that one should invest, what are some of the sectors where one could invest? So we have provided a chart that typically which sectors do well in a post-rate cut scenario for the next 12 months. And you will see at the bottom, there are averages, and the highest average returns you will see are mostly from the consumer discretionary space, obviously makes sense, from the technology space, from the industrial space also. Also, you'll see some good returns in the real estate space in a rate cut environment. So these are some of the sectors that one can focus on if they want to look at it from a broad sector perspective. We will not get into much detail. We have already discussed this, why we like these sectors. So we definitely like some of the sectors we like right now are mobile gaming, blockchain, quick commerce, telehealth, all these sectors. And there are some case studies from each one of these sectors, which will not go into the details. But if you have any questions, we are more than happy to address them in the Q&A part. So I'll